what wealth is, right? And it was three components. Being truly wealthy is having what you need as opposed to what you want, not owing people money, and having the freedom to do what you love to do. It's really as simple as that. While we talk about wealth management as if it's a singular activity, it's bringing down to the core of what we absolutely need in life, not having the stress of debt. And especially with today's speakers and starting with Pramod, how do you create incredible wealth to give you freedom to write that book, travel the world, spend time with your kids, grandkids? That's what it should be. It's not a race for having more and more money at all costs. That's how we look at wealth.
I think it's appropriate that Satyan mentioned that definition for wealth management, and it's perhaps the most important thing we'll learn all day today, or perhaps all year this year. Perhaps the most important learning, and we, for once, it ties into our Marcellus philosophy as well, because we are not out here to put you on the Forbes billionaires list. We are not here to maximize the returns of your savings that you give it to us. We're perhaps aiming to deliver the sort of returns that will fulfill your financial goals. I'm pretty sure the folks at Cube have done a great job in terms of your financial planning, goal-based planning, so that you fulfill all your aspirations in life. Whatever it is, to travel the world, like you said, write a book, do philanthropy, teach at a college, whatever it is, there is a target to it, right? And let's say for most Indians, correct me if I'm wrong, Satyam, I guess somewhere around the 15 to 20% mark as a target return on your portfolio should be a decent benchmark. We're not here to hit the ball out of the park or blow the lights off and double your money every year, right? So anybody who says that, you need to be wary of. Certainly, we are not trying to do that. All we're trying to do is, within your targeted return, can we reduce your risk as much as we can, right? In fact, instead of maximizing return, we flipped the whole philosophy. And as you, hopefully I'll be able to share over the next 20 minutes or so, in many ways, then whatever we know about investing is actually the other way, right? So instead of maximizing return, it's all about minimizing risk. Instead of finding the winners, it's actually about cutting down the losers. And as I take you through our own journey, which is perhaps pertinent, because that's when we can connect the dots between what we've been through and what we're doing today. Because none of us are born this way, right? So we've spent 16 years in the market. We've had to make those mistakes ourselves for us to go through and learn it. Hopefully, you don't have to pay for those mistakes. You can easily subscribe to our portfolio. Cube has kindly hosted our PMS on the platform. But even otherwise, you can purchase the book Coffee Cat Investing in the next 15 minutes and give you a very simple way of creating wealth for you, the way Satyan defined it, with very little risk, right? And risk is very, very important to understand, because the problem with most wealth managers in the country is they start out by talking about returns and pretty much stop there, when perhaps returns is the third point when it talks about investment management. First has to be your time horizon. Second, within that time horizon, how can I keep my money safe, which is reducing risk? And then given that risk and time horizon, what sort of returns can I realistically achieve? The folks at Cube can help you build it yourself. So it's basically a battery of 13 financial ratios, which we use to compare companies across different sectors. Because our belief is, if there's anything hanky-panky that the promoter is doing with the company, you will be able to figure it out in the accounting statements, right? Between the P&L, the balance sheet, the cash flow, the various schedules to accounts, the related party transactions, and so on. It's very easy to figure this out. Instead of going through hundreds of annual reports and then figuring out 80 of them are uninvestable, we created this small framework where you simply pull out the data from a public database like Bloomberg or Capital IQ, put it into these ratios, and the ratios quickly tell you whether this company is even worth spending time on research, because the promoter is not going to give you the money anyways. The model says almost 80% of the listed companies in the country, accounts are not to be trusted. If accounts are not to be trusted, the company is, at least your money is not safe in that company. Right? In some ways, it is unfortunate. In some ways, it is good, because then you don't have to run around the country researching 6,000 listed companies, right? So the sort of self-selection happens. So if you start off with, say, the BSE 500, which is by and large the large and mid and the largest small cap universe, this model throws out about 400 of them. right? Leaving about 100 clean companies to deal with. Now, the fact that these 100 are clean doesn't necessarily mean you and I can make money from it, right? Some of these companies may not destroy wealth for you because they're not looting, but it goes out about 80%, which is 400 of the 500 BSE 500 firms, leaving about 100 clean companies to deal with. Now, the fact that these 100 are clean doesn't necessarily mean that they can make money. Take, for example, a company like Wipro, perhaps run by one of the cleanest promoters in the country. I think Azim Premji, we all have heard about his philanthropic activities, but corporate governance wise, accounting quality wise, treatment of minority shareholders is right up there with the best of the best. However, if you look at Wipro as a business, used to be the number 2 IT services company in India about 15, 20 years ago. Now it's slid to maybe number 5. The last 12 years since Vivek Paul left as a CEO, Wipro's profits would have compounded at what, 8 or 9%? The stock would have also given you an 8 or 9% return, which perhaps is all right. Yeah, it's better than the 90% you would have lost in Yes Bank or Crompton Reeves or Diwan Housing. But I presume most of you investing in the stock market would aspire to earn anywhere around the 15, 20, if not 25% mark, and hence an 8% still doesn't pass muster. So from this list of 100 clean companies, we still need to find those which can give you that 15, 20, 25%. So they're a simple aspect of India, which is the other way around. Just like you have so many firms with accounting issues, we're also blessed with a few firms which can create a lot of wealth. And this, we accidentally stumbled upon this concept when one of my colleagues, Rakshit, who used to be a consumer analyst at Ambit, and he used to research some firms like ITC, Asian Paints, Pidilite, Marico, and so on and so forth. And he one day made an observation that, look, our country is a monopolized economy. You know, I asked him, what do you mean by that? He says that, look, as I research the different companies in my sector and I look at the product categories, while there are about a dozen companies in every product category, it's actually 1 or 2 companies which make up all the profits in the sector, right? More than 80% of the profits is either with 1 company or 2 companies. The rest of them simply bring up the tail. Take, for example, cigarettes is an extreme example. Just ITC alone makes more than 90% of the profits in the cigarettes industry. If you take, say, construction adhesives, so the Fevicol, Fevibond, the entire product portfolio belongs to a company called Pidilite. Pidilite makes more than 70% of the profits in the construction adhesive space. In decorative paints, between Asian Paints and paints, more than 90% of the profits in the sector. In even take a very basic product like biscuits, right? Britannia and Parle, 2 companies make up more than 80% of the profits in that sector. So like that, sector after sector, particularly where products are very basic, paints, adhesives, and biscuits are not any high-tech product that there is a patent or an IP protecting it that other competitors cannot. They're very simple products, yet India hasn't seen competition in these companies. And the sort of companies I mentioned, if you notice, most of them have been around for decades. From these 100 clean companies, how do you pick up such monopolies? The fact that these companies have sustained their dominance in their respective industries for long periods of time suggests that, unlike a typical capitalist economy, if one company is making too much money, soon enough it should attract competition. Competition should push down prices, push down margins, push down your returns on capital. That doesn't happen in the case of these companies. If you see, on an average, these companies' profitability as measured by a parameter called return on capital employed. Return on capital employed is the best measure of profitability because it not only takes into account revenue minus cost, it also takes into account how much capital you had to invest to start the business in the first place, right? So it takes both operating expenses and capital expenses, and therefore ROCE, in our view, is the best measure of profitability, and that for these companies is as high as 50% on an average, right? For example, ITC makes 300% return on capital in its cigarette business. Right? It doesn't take much cost, factory cost, everything is very, very low, yet it's like a cash machine. Now, in any other country, whether in the US or UK or Japan, in a typical developed economy, if you had seen such companies making so much money, making very basic products like biscuits and paints and stuff, you would have soon enough seen a plethora of biscuit brands, biscuit companies. In fact, if you've ever been to Western countries, walked into a Tesco in the UK or a Walmart in the US or even a 7-Eleven, the number of choices you get for biscuit brands or food brands, you would see that there's plethora of competition. But 50 years on, right? Britannia is more than a 100-year-old company. Parle perhaps is a 50-year-old company. These two companies have maintained their duopoly over the biscuits industry for as long and yet make so much money with no competition in sight, right? And that we figured was a very interesting paradigm to invest rather than the typical approach that we see today. And we've also been guilty of that approach in the past until we realized this paradigm. The approach is what? Find that hidden gem which nobody has seen, and we're hoping that over time everybody appreciates that stock and that becomes a multi-bagger. And the only way to make money is when you pick up a hidden gem and that gets discovered and you make the alpha. That approach works, but that approach is also saddled with potential mistakes, right? For every one hidden gem which actually turns out to be a gem, 2 or 3 turn out to be duds. So your net outcome on the portfolio returns got to be mediocre. This phenomenon of the same companies compounding their profits, compounding the wealth for their promoters, compounding the wealth for their minority investors, year after year, decade after decade, seemed like a much easier way to make money for us, right? Where you didn't have to take any risk, because a lot of the things that we look for in a company, when we try and pick the company, have been proven over decades for these companies. For example, you don't have to second guess Britannia's brand strength, or you don't have to second guess Asian Paints distribution strength, or you don't have to second guess HDFC Bank's management capability, right? A lot of it is out there for all of us to see and has been proven over long periods of time. Only 2 parameters are good enough to figure out the compounding engine, right? One is, like I said, the return on capital employed. It has to be the holy grail. Never ever buy a company whose return on capital is not greater than its cost of capital. By the way, 30 out of the 50 Nifty companies have that situation, right? Which is why the Nifty has not made any money for investors over the last 10 years. When I say any money, right, so Nifty is returned, what, 10% in rupee terms, that's 6% in dollar terms. Compared to the US S&P is delivered 14% in dollar terms over the same period, right? India, despite being an economy which is growing at perhaps 3 times the nominal rate as the US market has made more than double the returns as India over the last decade, simply because the benchmark index is full of such either mediocre companies or, like I said earlier in step 1, fraudulent companies. So return on capital is the first parameter. We look for companies which have had a return on capital of at least 15%, which is broadly the cost of capital in the country. 15% for every year over 10 years. And the second parameter we choose is revenue growth. Revenue growth we choose as a proxy for reinvestment, because the compounding machine works in where, imagine yourself running a business where when you start a business, you have to put up some capital. On that capital, you want to generate a profit which is greater than what you would have earned had you put your capital in Cube's wealth management platform. Cube's wealth management platform can deliver, say, a 15% return. So instead of putting your hard-earned savings into Cube, you decide to open a business. If that business is not even giving you 15%, you should shut down that business, right? Now, hopefully, you will run a great business which will make a return on capital significantly greater than 15%. And that gap between 15% and your return on capital is what we call as the free cash flow, right? Because that is your true profit. Now, with that profit, you can choose to pay yourself a handsome dividend. You can pay the whole thing as your handsome dividend. Or even better will be if you are in an industry where you can reinvest those profits back into your business so that your next year's profits becomes larger, right? Because the capital invested grows. On that increased capital invested, you make a return on capital higher. And that's what a compounding engine is. So instead of looking at that reinvestment rate, we look at revenue growth. Revenue growth we look for is minimum 10% every year for 10 years in a row. 2 simple parameters. Return on capital of 15% every year, 10 years in a row. Revenue growth of 10% every year, 10 years in a row, right? Why do we take 10 years? If you take a shorter period, a few lucky companies might pass these tests, right? Coronavirus is a grim reminder for all of us that we have no idea what the future macroeconomy is holds it for us, right? There is no way you can build a portfolio based on future economic forecasting, which is why we take a 10-year period, because 10 years is long enough for the economic cycle to have gone through its entirety. In any 10-year period, you'll see GDP growth would have gone up and down, interest rates would have gone up and down, commodity prices would have gone up and down, even the technology involved would have changed dramatically. The government making the policy, the political party in power would have changed. Maybe you would have had one more war with Pakistan. So lots of things would have panned out in that 10 years. Yet, if you manage to find a company which has delivered a 10% growth and 15% ROC every year for 10 years in a row, that means that this company is relatively immune to the external conditions. More importantly, it has something intrinsically special about itself, which allows it to be immune to these external conditions. And remember, when you make these financial goals with Cube, you will want to achieve those goals irrespective of how the world pans out over the next 15, 20 years. Our financial goals are absolute. Why not construct a portfolio which is likely to deliver that absolute return and has very little dependence on the external environment? This is more qualitative. It involves, we spend at least 6 months to sometimes as long as 2 to 3 years to understand a company from a bottom-up perspective. It involves running around the country. There's no rocket science in this step, right? It is simple common sense, because business is common sense. We learn from meeting people who've done business with the company in question. Could be distributors, could be dealers, competitors, customers, ex-employees, retired CEOs, CFOs, any regulators to the industry, any consultants to the industry. So anybody who can help us understand the business on the ground so that we find the answer to our biggest question. The biggest question is, okay, so these 15 companies so far we know are clean because they passed the forensic filter and had a great past, at least 10 years of consistent growth and profitability. But we are interested in the future. How are we to be sure that these companies will have as great a future as their past? And the answer to that question lies in, does the company have a moat? This is Warren Buffett's terminology. I don't know how many of you got to dial into the annual meeting last night. But the terminology of a moat is effectively a trench that surrounds a castle where the king and queen and his family is there to protect, right? So that enemies don't attack. So if you have a beautiful business which is making a lot of money, like most of these examples that I've given, obviously that is like a castle where competitors are looking to attack that profit pie. If you're Asian Paints and make 50% ROC, I as Jindal Paints or Sherwin-Williams will want the slice of that profit pie, and hence I will always look to attack your castle. To protect your castle or protect your business, you need to build a moat or trench around it so that the enemies cannot cross that. And this is a dynamic concept, because if your moat is the same as what it was 5 years ago, enemies would have figured out ways and means to build a way to cross the moat or swim and swim across and attack your castle. So you need to keep deepening your moat, widening your moat, and like Buffett says, throw some crocodiles into the moat. And that's a dynamic concept. What made you different from competition today will not be enough to keep competition at bay 5 years down the line. So you have to keep working on it, which is where the assessment for us becomes even more harder. First, assessing the here and now is one thing. How are we to be sure that the management is alive and awake to these threats, that they keep staying ahead of competition even 5 years down the line? So which is why we take 6 months to 2 years to assess. We meet at least 50 to 100 people associated with every company. So we try and pick the best out of these companies and build a portfolio.
So to the audience, just be careful. You can be your worst enemy in investing, because the opposition is so loaded with so much more knowledge and insider information in India that it's not an even war.
I think Amit and Varun both wanted to, pose the simple question about what are the biggest mistakes that you see investors making while they're investing in the markets, and what would you kind of, want them to be wary of?
So one thing which I started off from, and I can't emphasize on this more, that don't try and maximize your returns in the market, right? There is no such thing. Every asset class has a certain median returns. Returns have to be commensurate to your financial goals. As long as those returns are fulfilling your financial aspirations, start focusing on reducing the risk for the same set of returns rather than maximizing it and aiming to come on the Forbes billionaires list. And that's something that I see pretty much every day. So get your guys at Cube to do your financial planning. Set that goal for yourself. This is the return. This is the risk I want to operate that return with, because all of us have different risk appetites. And mind you, most of us tend to overestimate our risk appetite. We all think that we're all long-term investors. I don't mind taking a little bit of losses in the short term. When in reality, the human brain cannot digest red on your portfolio statement. Simple. You know, Daniel Kahneman won the Nobel Prize for saying this, right? Human beings operate on loss aversion, right? If you make 100 rupees profit and 100 rupee loss, the 100 rupee loss hurts you more than the happiness you derive from the 100 rupee profit. And therefore, whatever you in your first cut believe is your risk appetite, hammer it down even further. That is the risk parameters within which you should operate, and then see what best returns you can generate within that. So number one. Number two is this whole thing about timing the market. Is this a good time to invest? All the time we find investors asking that. So especially I can talk about equity investing because that's our forte. When it comes to equity investing, the one thing that I tell people is do not put a single rupee in equities that you need in the next 3 years. Never in, whether it's with Marcellus PMS, whether it's with some other PMS or mutual fund, or you buying stocks directly or an index fund, equities should not be invested with less than a 3-year horizon. If you take a longer horizon, the reason we don't take is in the short term, equities are an extremely volatile asset class. I don't need to say that. Thankfully, I'm sitting on 3rd May when I look at March and April as 2 months where equities moved 30% down and 25% up in 1 month each. And had you had any short-term horizon in this period, God forbid, all your financial goals would have gone completely awry. So, but that's the nature of equity markets. They are supposed to be volatile in the short term. The only way to kill that volatility is give yourself extra time. If you take that 3-year plus investment horizon, then the whole need to time the market gets obviated. And here's the bigger reason why you should time the market, because it is not possible. I would, 3 years ago, I used to say it is difficult. 3 years hence, now I say it is impossible. With the sort of changes that have happened in the trading technologies, algorithmic trading, the rise of ETFs, the rise of leverage, to almost 12th year of QE happening where you can borrow at 1% and buy an S&P index fund in the US means that there's so much leverage. The sort of movements that you saw in March, up 30% or down 30%, and then back up 25% in April, is a reflection of these changes in the market. And therefore, A, it is impossible to time the market. B, if you have an investment horizon of 3 years plus, there is no incremental benefit to timing the market. So these two perhaps I will stick as the most common mistakes. And the third, I guess at some stage you will ask me, is about these valuations and PE ratios, which is the biggest mistake people make these days, because the world is changing and the PE ratio, the concept of PE ratio is being abused so much, right? PE ratio is supposed to give you an indication of the valuation of a company. It is not science. The reason PE ratio cannot capture the full value of a company is, think about it yourself. What does the PE ratio capture? It captures today's stock price and this year's earnings, or at best last year's earnings if you're being very conservative and taking a trailing PE. However, you should know that the value of a stock lies in the present value of the cash flows that the underlying business will generate to perpetuity, right? This year's earnings, most companies' cases, will not contribute more than 5% of the value of the company, right? And the PE ratio cannot differentiate between two companies with two different growth rates. The PE ratio cannot differentiate between two companies which have two different longevity of growth. right? If one company is growing at 20% and the other is growing at 10%, obviously the one grows at 20% should be more richly valued. If both are growing at 20%, but one grows at 20% for 10 years, but the other grows at 20% for 5 years, naturally the one that grows longer has a much higher value. And third, let's assume both grow at 20% for 10 years, but one grows in a straight line and the other is extremely volatile, plus 40% one year, minus 20% the other year. You'll naturally prefer the one that's growing in a straight line, right? All these factors create the value of a business, which are not captured at all by PE ratios. So this whole thing about high PE companies should be avoided and low PE companies should be bought is the biggest myth and is the easiest way to lose money, because PE is a factor you need to consider, but it is possible that a high PE company is cheap and a low PE company is expensive. Maybe if we have more time, we can get into depths of these. But the one thing that I would like to remind all the audience is, whatever you're hearing me talk about, we've written about these in far more lengths in our blogs, in our books. So if you're keen to know more, you can hop onto our website, marcellus.in, where in the blog section, in the newsletter section, in the video section, you'll see a lot of tutorial type material. Maybe you'll find it handy.
One of the questions was, you spoke about Britannia and Asian Paints and all these companies. Ashish, I think this was a question by Ashish, where he wanted to know if you believe that given the scale at which these companies operate, do you think that their revenues, their profits, can they continue to grow in the future the way they have so far in the past?
Right. No, good question. I think this is again one of the most common mistakes people make, that there is an assumption that the smaller the company, faster the growth, right? This perhaps applies in Japan, right? Digest is that we are still a third world country. We are a country with a lot of poor people. So the operating words are a lot, which is why we have 130 crore people, and poor, right? You mean most of the audience here is not India. Bulk of the audience in bulk of India is living in tier 3, tier 4, tier 5 towns, where for them consumption is just, their entire consumption basket is all of essential goods, which will allow them to carry on with their lives. Coronavirus. Right? If you are in the business of producing such goods and services, there is no dearth of demand, right? If you look around your windows, I sit in Bombay. Thankfully, it's been clear given the lockdown, but it's full of shanties. The country needs to be painted twice a day, right? You can't say that Asian Paints with 55% market share has no more room to grow, right? So here's another example with specific to paints. 85% of paint demand in India is from repainting, right? Even if you don't build a single house ever in India, that demand will remain. The typical repainting cycle in India is once in 7 years. That number in the West, in a developed economy, is once in 3 years. As India becomes more affluent, most of us will start repainting our houses far more frequently. And that once in 7 years moves towards once in 3 years itself becomes a growth driver. And on top of it, remember the number of homeless people, number of houses India needs to construct. So one thing you need to remember, as long as it's a product which is essential to the common man in India, the growth runway is seriously long. Whether it's Britannia's biscuits or Asian Paints paints, I'm saying that you don't even have to make a very benevolent bet on the current dispensation, unless you assume that the current government will destroy the economy in such a way that we'll go back to Hindu rate of growth. Even if you're modest in saying that, look, India will continue to grow at 6% real GDP terms. I'm not talking about 8, 9, 10% and all that. 6% real GDP growth for the next 10, 20 years. Most of these companies will see a growth opportunity for them to grow at 15, 20% for the foreseeable future. The other aspect of this question, related question, is do not get stuck on demand. So with this aspect, you should be comfortable with the demand opportunities for most companies in this space. The more important thing you need to watch out for, if the growth runway is so long, right, it will always keep attracting competitions, particularly the foreign competitors will keep coming to India because there is no growth elsewhere. They come to India seeking this growth opportunity. So in fact, before deciding a company to invest in, you don't need to look at growth. Growth is a given in a poor country like India. You need to look at how are the barriers to entry for this business, right? If Sherwin-Williams enters the country, will Asian Paints be able to defend itself? That's a much more important question to answer than to figure out whether paint demand in India will continue to grow or not. So in a poor country, large companies don't have any dearth of growth opportunities. And more importantly, um, um, the growth runway is pretty long. So, and there is also a phenomenon that is happening, and particularly accelerated by events like this coronavirus. We saw a demonetization, GST, and so on, which in some ways actually puts the advantage in favor of the larger company. In every country in the world, you're seeing the larger companies are becoming larger and larger, and the smaller companies are getting hurt because of these events. The coronavirus will certainly hurt a lot of small businesses. The larger companies have the balance sheet to survive this crisis and the competitive advantage to take market share even in a period of crisis like this. So in fact, when the recovery happens, you will find that there's a massive consolidation happened in every industry. The few companies that remain the last men standing in every industry tend to take a disproportionate share of that recovery, because the small companies, some of them will die permanently. Some of them will go into coma and will be sort of revived through the next bull cycle as liquidity improves and the balance sheets get repaired. So in a perverse way, perhaps you're better off in investing in the dominant market leader in every industry.
Our portfolio management services only for the ultra rich, and what all is covered under PMS?
Sorry, I just missed the last bit. You're saying what all is covered under PMS?
Yes. So I think the question is more about our PMS services only for the ultra rich, and what will I essentially get if I enlist for one?
Right. So no, the SEBI, which is the regulator for our industry, increased the minimum investment from 25 lakhs to 50 lakhs from 1st January this year. So clearly, I think somebody investing 50 lakhs in a PMS would have, my sense is, about 2-3 crores of investable surplus. This is the investments outside their primary residence. So that would classify as, you could say ultra rich. The service is simple. The service has evolved. Portfolio management service, when it was first introduced 25-30 years ago, was where investors wanted to invest in stocks directly, but they were not experts. Therefore, they went to a professional to say, I want the stocks to remain in my own demat account in my name. Can you provide me the guidance so that this portfolio does better than what it would do had I be doing it myself? But over time, it's almost morphed into becoming a fund of sorts. The way we run the PMS is just like a mutual fund, except we have fewer restrictions than a mutual fund. Mutual fund, for example, doesn't allow you to invest more than 10% of the fund in one single stock. PMS doesn't have such restrictions. Mutual fund is not allowed to charge performance fees. PMS are allowed to charge performance fees, which is one of our biggest USP, and we take a lot of pride in saying that we have a fee option where we don't charge you a single penny if we don't deliver a minimum 8% return. At zero fixed fees, 20% of the profits, above 8% return, right? So those are two big differences. There are some minor differences as well, but that is what makes PMS slightly different from a mutual fund. That doesn't mean that all mutual funds are bad, all PMSs are good. There are good and bad mutual funds. There are good and bad PMSs. The folks at Cube, they'll be able to help you figure out which are the good ones, which are the bad ones. But unfortunately, as much as we would wish to offer our service to pretty much everybody who is looking to invest in a safe and sound manner, we are bound by our regulations of taking minimum 50 lakh ticket sizes. Hopefully one day we'll be in a position to launch a mutual fund and cater to everybody who can invest a minimum of 500 rupees.
So I just wanted to add to that, and this is a great question, and I think SEBI in its infinite wisdom increased 25 to 50 lakhs, which I thought was a great disservice, right? Because you've effectively made it harder for people to access top quality managers like Marcellus, etc. But we'll work out and see if we can be creative using technology here. Pramod, I wanted to counter with what you said on the net worth, 2-3 crores. Let me paint a scenario. If I'm in my peak earning years, have a steady salary, I have some money kept for emergencies, the next couple of years of expenses, right? Would you say then, and say my net worth is, about a crore, would you say it is still okay to park 50 lakhs in a PMS from a crore, as long as it's for your retirement? So 10, 20 years out, right? You said initially that 3 years minimum for equities, and Cube actually we say if you touch direct equities, 5 years minimum. I'm saying in this scenario, if you're thinking, I have this, I don't want to touch it till 2040 when I'm retiring, is that a viable and reasonable option to put in a PMS?
I mean, yes and no. There are no easy answers to it. I might be even biased in my answer. Look, ultimately, there is a concept called portfolio diversification, right? And the whole idea of diversification is to reduce the risk, right? Because you don't want to, simply put in plain English terms, you don't want to put all your eggs in one basket. If you have 1 crore, you don't want to be putting 50 lakhs, half of your net worth, into one fund manager, although that fund manager will be in turn diversifying it anyways across 15, 20, 25 stocks. But having said that, you don't know those stocks. You are only making an assessment of the fund manager. Just like we diversify our portfolio across 10, 15 stocks, I won't say that you should diversify across 10, 15 managers. That's too many. But I would say 3 portfolio managers is max. You should look at 2 to 3 portfolio managers you can diversify. Now, where I said I was biased, and you can still look to answering your question with a yes, is if you've understood the portfolio, the said portfolio manager's risk approach, right? Like I said, that whole filter-based approach itself will reduce the volatility on your portfolio to the level of a government bond. Think of it like if I'm investing 50% of my net worth in an asset class which is as low risk as a government bond, would I be then worried? Would I then want to further diversify the portfolio to reduce the risk further? No. The question is, can you get convinced that the Marcellus consistent compounders portfolio is indeed a low volatility portfolio? And hence what we say on the tin, which is the 6 to 7% standard deviation on a 3-year plus basis, is indeed real. If that is the case, then I won't hesitate in putting 50 lakhs out of my 1 crore savings into such portfolio. But that's a decision for you to make based on the judgment you make on us as portfolio managers.
Absolutely.
For us, we have done it, right? All Marcellus employees and founders have to invest only in Marcellus products, right? All my money, my colleagues' money are all in Marcellus products. And we have 2 products. One is the consistent compounders PMS. The other is the Little Champs PMS. I'm a relatively conservative guy compared to some of my more adventurous colleagues. I put 25% of my wealth in Little Champs, which is the small cap portfolio, 75% in consistent compounders. Some of my other colleagues have put 40, 60. But that's a matter of asset allocation. But we've definitely put all our net worth into just one PMS.
Absolutely. And by the way,
nothing that we do is rocket science, right? Whether in our investing or in the forensic accounting. The last scholastic skill, and perhaps the most scholastic skill that we picked up, was in grade 6 when our teacher taught us about compound interest. And I absolutely agree with you, Satyan. The power of compounding is just magical in terms of the wonders that it can do to your savings, which works only if you let your money stay for longer periods of time.
If anybody's experienced Costco in the US and a combination of the new Apple credit card that's launched in the US as well, saying how can we keep things simple but also create benefits for our most loyal customers? And the 4 areas of benefits that we are launching, and all of you are part of this beta program for free. It's going to be a paid program going forward, but it's a 2-month beta which is free for everybody in this session. Is the exclusive wealth webinars like the one you're attending. We are going to do them regularly. We're going to take feedback from you on what was interesting and keep improving them so that your level of education goes up about how to think about investing, even though you might not do it yourself and you trust the experts. Extra returns on investments. there will be certain products where Cube Prime members will make an extra amount on top of what they are already getting in that asset itself, which is very exciting. And we want to do this almost like a loyalty cashback program, like how Apple's credit card has. Additional extra rewards around things such as when you refer customers, we already give great rewards. Our Monopoly game in the app has rewards, including if you refer a certain number of customers, you can win a guaranteed iPad, etc. Cube Prime customers will get even more rewards than that. And then premium personal service, which will include a WhatsApp group with Cube's engineering team as well as leadership team. So you have almost 24/7 access to questions, feedback. You'll also get access to our product roadmap, so you can have feedback for us on what you would like to see built in the future, and we can prioritize that. And we are going to do regular reminders to you every quarter on analyzing your non-Cube mutual fund and stock portfolio, something that we all forget out of lethargy. But we're going to remind you, if you're a Cube Prime customer, saying, let's take a look at this. This is what you're going to experience at the end of the day today when you do the financial analysis we've offered to everybody attending the seminar, where we're going to analyze your portfolio. We're going to do that every quarter for you as part of the inclusive package. And if you add your family members inside, so we have the concept of a family CFO. In any family, there's one person who's handling finances for the spouse, for parents, maybe children, siblings, etc. One Cube Prime account will cover 3 family accounts for a single membership fee when we start charging. So easily, your benefits can cross rupees 50,000 by just using some of these features. So all of you who are here are already enrolled, but feel free to pass this link if you see other family members or close friends who are interested, and we can put them on the wait list.
First of all, why should you all invest into alternative assets, right? So the good part is, if you understand that today's world, having multiple sources of income is no longer a luxury, it's essentially a necessity, which essentially says that we need to have multiple thought-backed, researched investments to help us tide over such crazy scenarios that we're currently facing, right? So even if you Google, you'll be shocked that alternative as a definition just says that it's like a substitute, or it's a relief piece, or a fallback upon, or a backup, right? To ensure your traditional pieces, if they break up or if they have some issues, you have something which is of great quality, right? You'll be shocked that the world's largest financial service player, I'm sure everybody would have heard about them, BlackRock Group. You'll be shocked they manage around 7 trillion USD across 100 plus countries. And these guys who've been experts over last multiple decades, they also have been saying that a traditional 60-40 approach, which most of the investors have, right? Somebody would have 60% equities, 40 in debt, or the vice versa, essentially is no longer enough to meet your long-term investment goals. And why are the world's biggest guys saying this? Because they have seen multiple issues that have cropped up in the past. So today we are facing the pandemic. 12 years back, we were facing the Lehman crisis. Before that, in 2001, we had the dot-com bubble, where people lost a lot of their savings, and in some cases where they were not able to even meet their regular expenses, right? So that's why people think, and people should have alternatives which can essentially help them lower volatility, enhance returns over time, and provide higher levels of income in a portfolio. So essentially, what if alternatives are in, and if people should have an exposure toward them, what essentially is going to impact a good alternative portfolio, and why should you have an actual exposure to it? Because with time progressing, there's a lot of technological innovation. Sustainability is at question, right? There are a lot of initiatives that are coming in today, which essentially did not even hold sense 10 or 20 or 30 years back. So unless we also adapt and innovate, we'll not really be able to compete in these times, especially when inflation is growing high, right? So look at products which have been always sustainable over a long time, right? Alternative, something like your Britannia, who keeps on giving you breads in these pandemics. Something like your HUL, which give you soaps, or a lot of daily utility items, which maybe even in the bad time you will consume, right? Similar, financial services, right? In a good or bad time, you will allocate capital, you will require services. So these businesses which are sustainable over a long period of time and can give some edge to you and can give some alpha to your overall investments, that's why alternatives essentially work for you. Right. So I said about 5 important risks, right? One is alignment. None of these fund managers are aligned to you. So they may not charge fees, but if you make losses, they are still not gonna be happy, but they're still not gonna make monies, but you still make losses. What the fund manager was aligned to you? If he shared losses with you, if he did not make return until you just not recovered capital, but also your return, if he diversified well beyond any man's reach, if he did not really get impacted by macroeconomic situations like today, and if somebody could really create a portfolio where diversification was beyond not just 10, 20, 30, 40 names, but across 100 or 200 entities. Today, at LiquiLoans, we've created such a product, right? Where we are completely aligned. We essentially do not even make a rupee of income or fee till the time you return, get back your capital as well as your return. We diversify across 5 times than any good debt mutual fund, or maybe even 10 times of PMS, into a safer asset class of retail borrowings, right? So all these corporates, we've seen in the last 2 months, practically 40 days of the lockdown, that a lot of corporates are not functioning, right? So they will surely have losses. And all of these companies, eventually some or the other, have debt. Very few companies essentially are practically having no debt. But still today, in the worst times, they're still paying out salaries. So that's a negative cash flow for them. Eventually will take a toll on that profitability. But what if you got the underlying of good retail borrowers who are also consuming good services in the bad times? Something, as I said, is in demand, right? So people are opting for online education. People are opting for stem cell treatments who already plan kids. People who want to plan kids are opting for IVF treatments, right? The demand of such services, even in these worst pandemics, don't really go down, right? And if I could get good borrowers who want to consume these services, credit rated borrowers, prime borrowers who have the track record and the ability and intent to pay over longer periods of time, all debt that they've taken, will enable me to make great returns. So eventually, what we do is we provide such unique loans at 0% to these prime borrowers, align ourselves to you, saying that the returns from the whole transaction will first be given to you, only post a specific hurdle, the balance is expensed to us, right? In a scenario where we are not even betting on the retail borrower. So today we are stressed that all our investments into bank FDs, all our investments into debt mutual funds, all our investments into various instruments which have exposure to corporate debt or retail debt might take a toll, right? That people will not repay, will opt for moratorium, and eventually your returns will get impacted. But what if I'm not betting on the borrower? I'm just asking him to repay the principal. I'm actually making returns from these organizations who are providing services, making a very healthy return out of that, and passing the first come first return to you. This in sense makes a good alternative investment proposition, where when your monies are essentially not given to leverage borrowers, nor they are given to credit hungry borrowers, but are given to borrowers who did not even want the loan, but took a loan for payment services, right? Similar to how we use credit cards today. We may have enough and more money in our banks, but we want to have better convenience, right? We swipe 20, 30 times a month and pay before our due date. Similarly, we provide 0% loan to such borrowers who did not want a loan, but just took it for payment convenience. They repay back principal on a monthly basis, and the return comes from the service manufacturer who has enough and more margins, right? Which in turn help us earn a great double-digit return. Out of it, the first 10 to 12% return goes out to you, post which I make an income. Second, unlike even the best case AAA debt mutual fund, which has not more than 30 to 40 underlines, which again is a stark ratio, because India supposedly has 150 plus credit rated, AAA rated companies versus good developed companies like US. You'll be shocked, in a country which is practically 15, 20 times our GDP, right? We are practically at $1.5 to $2 trillion market versus US being practically a 20, 30 trillion dollar market. They have 2 AAAs versus we have 150, which essentially says that we don't really assess well. We essentially, all these credit rating agencies essentially are giving out AAAs without even looking at the quality of the balance sheet, but actually are giving just because of the size of the balance sheet. So even if your best case monies were invested into a AAA debt fund, you may have seen losses, because the underlyings really withered away. Good names like maybe at one point of time, ILNFS, D1, JSPN, Yes Bank, all withered away. You may have either lost principal, you may have either lost interest, right? But what if you got an entity which was not levered? We had more diversification than even a AAA fund. So AAA fund would have 30, 40 entities. Today, a good retail debt portfolio has 200 underlying entities, which essentially minimizes your risk to a large extent without having interest rate shocks, right? Today, even your debt fund, which are ITM based, which do not have a stable return, right? Even the interest rate cuts happen in the economy, which we have seen in the last 6-8 months or practically a year, your rates have actually fallen down. You may have not really made the yield that you were supposed to unless you held to maturity, right? And most importantly, nobody's going to share risk. What if a fund manager essentially shared all of this risk with you, was 100% aligned to face the first loss of any? So we at a company level absorb first 15% NPAs of any coming out of any investor's portfolio. The industry average NPAs have been in the range of 1.5 to 2% gross the last 10, 15 years, right? Practically having 10x buffer, even in the worst case scenario, even if the industry numbers double, triple, or quadruple, even at 6, 7, 8% NPAs, which again don't seem likely and unheard of, even if they occur, you don't lose a penny, right? So you need to always have an alternative investment which ensures your capital is protected. You don't face volatility. You get monthly returns or an annual returns which are more predictable with a higher probability and are secured.
I wanted to mention 3 reasons why I like what you guys are doing. Number one is you're using technology to regulate what was an old boys network amongst HNIs, right? Where a broker would call saying, इनको पैसा चाहिए 18% interest मिलेगा, आपको देना है या नहीं. You have created a formal system which comes under RBI, so it's audited, to replace that with technology, so it's scalable. Number one, which I love, right? It creates democracy in creating wealth for many more people. Number two,
and that's going to be the way ahead. So essentially, India, as I say, has always been not tapped correctly by various banks and NBFCs. We are still under-penetrated in terms of credit opportunities available to individuals, because a lot of informal monies flow within the country. But because of demon, a lot of people have come under the banking net, have been now offered good credit if they have a good credit history. So that will eventually aid to a much better developing economy and will fuel growth across segments.
Absolutely. Number two, which I love, which is under diversification, is of course we have a lot of products in Cube around equities, around debt, etc. This is a product that is independent of the stock market and that listed market. So if you want to diversify, if you want to even out the ups and downs of the stock market, this is a good hedge against that as well. And number three in particular, which I love what LiquiLoans is doing. So I was an early skeptic around P2P when P2P launched in India, saying that India mein, how will people ever repay back? Who's going to go after somebody who borrows money, right? And then we always want to figure out what's the loophole in the system to not pay back. What I love about what LiquiLoans has done is there are so many layers of safety, right? And this is by no means to say that there can't be a default, but the layers of safety are showing up in the track record where the NPA is below 1%. So default rate is less than 1%, but this is across your entire portfolio, but that's also factored in. So one, customers are coming to merchants. The merchant is on the hook to pay back LiquiLoans. So they have a long-term relationship they want to maintain with LiquiLoans, so they want to control that. Second is they're only giving to high quality borrowers. Third is that they've left so many buffers in the economic model that Cube does due diligence on to make sure they're making enough money to absorb any ups and downs in returns that happen. And the first return that comes back, the first amount goes to the customer first. I think these are the layers which give me confidence. And again, like all our other assets, or multiple people in the Cube team invest personal money in LiquiLoans as well, which is obviously an important part for us.
Absolutely. So we've been happy that Cube was one of our first backers, and they tried and tested their own personal monies with the model that we've created, built in trust and visibility over time. And only post which this product was introduced within the Cube network. As Satyan rightly said, right? India has good audience, salaried income earners who don't take too much leverage, but have the capacity to consume more, right? So look at our demographics. We have the world's youngest population. In the formal economy, nearly 70-80% of the people are salaried, employed into various large sectors. We've been growing our GDP way higher than various other developed countries also. There's a great market here which everybody wants to tap, but essentially also has to ensure that risks remain minimum. And in good quality portfolios, always this will be the best element, where if you could give monies to people in a regulated scenario where they don't even have to pay some interest. So eventually connecting a great investor to a great borrower without the intermediation of a bank or NBFC, which essentially eats up a lot of returns of yours, right? Today, you may go to a bank, invest into a bank FD at maybe with SBI at 5.7% annually, versus go to the same bank to consume maybe a home loan or a two-wheeler loan or a four-wheeler loan or even a personal loan. Rates vary from 8% to 12, 13%, right? So you're shocked that on your monies, you're just making 5.7, versus when you want the same monies back in form of a loan, they're charging you 8, 10, 12%. A branded NBFC may charge you 15, 18, 20%, right? So there are a lot of leakages in terms of the fixed cost that these guys bear, the profit margins that these guys keep. But if I could transparently connect a good lender to a good borrower, ensuring that lender makes a better return, the borrower gets efficient cost of capital, becoming a win-win for all players in the economy, right? And this model will keep on growing well. So Bajaj Finance is one of the industry leaders who've been doing this right by giving a 0% loan for a lot of consumer durables in the past, not even charging a penny of interest from the borrower, but still giving a 6 or 7% return to the investor through an FD or NCD, where they essentially are making income from the dealers. We do the same thing, but for services. And as Satyan rightly put, in an economy where we are scared that if I give monies to a certain borrower, will he repay or not? The good part is, because of the mechanism brought in by the RBI, where we take in NASH from all of these borrowers, where there is auto debit of all of their bank accounts in terms of principal repayments on a monthly basis. And even if the NASH bounces, it's a criminal offense, right? This essentially ensures that good quality borrowers always will repay back on time, because they're not even going to pay a penny of interest. The returns are actually coming through subvention, which is essentially the discounts provided by these service manufacturers. All in all, making a win-win situation and a well-diversified situation, right? So in India, you had 30, 40 entities who were AAAs, and even in some AAAs faltered, you lost some portion of your principal or interest, because there was some amount of concentration as a risk, which not many people understood a few years back, right? They thought that debt mutual funds can never lose money. We saw last month, that's why we go 10x of what the RBI regulations also says. We actually diversify across 200 prime borrowers, ensuring that the risk remains minimum, plus aligning ourselves to absorb first losses and only make returns after the client makes his capital and the return.
Only one question I have to start off with is what should I look out for when I'm getting into alternative investment assets? What would you say are red flags if I'm getting into this? And what would you look at and say, "Acha, ye green light hai. I should go ahead and jump into this because it looks pretty legitimate."
Perfect. So I'll break this down into 3 parts. First of all, look at who the product manufacturer is. Is he well backed or not? Do they have any experience doing this type of investments? So I'll give you a brief about, you'll have to look at multiple layers. Look at who the manager is, what risks are you taking with the manager, what risk are you taking with the asset class, what risk are you taking with the underlying, all of these. And this essentially again goes back to what we say. We've been backed by great people like Matrix. So not many people who know Matrix Partners, but one of the largest investors and the oldest investors in Ola Cabs, Quicker, M-Swipe, Razorpay, right? We've been backed by angels who have been India's largest wealth managers in the country. So at one point of time, Barclays Wealth, their India CEO, Mr. Satya Bansal, is an equity investor. Mr. Kunal Shah, a tech entrepreneur who sold Freecharge for 2,800 crores and currently runs CRED, C-R-E-D. A lot of you may be using it, right? It's a credit card payment app, utility app, which is again worth 2,500, 3,000 crores. They have backed us, right? India's largest taxpayer of 2016, Mr. Ashutosh Toparia, who also owns a stake in Anandi Hospital, he's backed us, right? So first of all, you need to see that if good, genuine people have backed a new entity, if the entity has done business in the past. So before LiquiLoans, we were also into a business called Rento Mojo, where we used to lease furniture and assets. created an 800 plus crore company in less than 3 years, got backing from the world's largest consultancy firm called Bain, largest venture capital firms called Axel, who are investors in Flipkart and Facebook. So have been there, done that. So essentially, if you, the promoter sanctity in terms of they being aligned to each and every business that they ran, they being aligned to what the concept that they created, and have been moral and ethical, that is the first point that you have to look at. First, we look at what type of businesses are they doing. Are they doing some risky business, non-transparent business, illiquid business, something like a PE fund or a VC fund, which is long-ended, 7 years, 10 years. You don't have enough and more transparency. Sometimes your money gets locked in for a time period that you can really get out of. Look at products which are actually, when you start, look at liquidity. Whether you can redeem your money is worst case in T+2 days or T+5 days or a month or 6 months, depending on what product are you doing, right? Look at underlying, whether the underlying gets hit in the bad times, right? As I said, sectors which always have consumption, be it your breads through Britannia, your utility products through HUL, your financial service products, your services like healthcare, right? You may not see a lot of people doing a lot of expensive healthcare today or healthcare procedures today, which are discretionary, but want-based healthcare needs, something like a stem cell or IVF, right, will have perpetual demand even in the bad times.
People are asking, talking about mostly the risk and wondering whether in uncertain times like this, how do you think recovery and lending will work? Your views, really quickly, if we can talk about the risk and how we can cover that base.
Absolutely. So in terms of lending, there are two important things that you have to judge whenever you're lending money, right? That the borrower has the ability to pay, and second, does the borrower have the intent to pay, right? Two most important criteria is lending to anybody in the world, right? This essentially is filtered in our process through multiple parameters. First, we look at the guy's credit score, right? The average 700 plus credit score on a 300 to 900 rating scale says that he's been a prime borrower. And this score is only achieved when you have at least 4-5 years of validated track record of paying all your debts, be it your credit card dues, your small or big EMIs, on or before time, right? It says the guy has the ability to pay and also the intent to pay, or else he would have not moved over a 700 score, right? Second, whether he's salaried or not. Salaried borrowers largely have good visibility of income and consistent income versus even a self-employed person, right? Self-employed person may be making me 10 lakhs a month, but in a bad time, next month may have a 10 lakh rupee loss also, right? But a salaried guy who's making 100,000 last month will keep on making that 100,000 more or less, unless he's impacted badly through the pandemic scenario, right? People may lose 5 or 10% salary, but not all, right? If you look at people who have consistent income, even in good and bad times, again, a good set of borrowers. Third, recovery. How do we recover monies from them? Not charging any high absurd interest rates, you will always ensure good quality borrowers come on the platform. The recovery of only principal comes through NASH. As I said, NASH, Section 130 of Negotiables Instrument Act apply. The criminal offense if the NASH even bounces. But moreover, when we are looking at a borrower, whether I should first approve a case, I will look at his indebtedness. Let's assume a borrower is making 1 lakh rupees a month and was spending 30,000-40,000 a month. Seems to be a good borrower, right? He's spending basic monies for his maintenance, his existing card expenses, his EMIs, in some cases rent, and saving 60% of his monthly income, right? Our ticket sizes to one such borrowers are typically 45,000-50,000 rupees, which also they have to pay over 8 to 10 months, right? A borrower who's making maybe 12 lakh rupees a year has to just pay 4,000, 5,000 rupees a month over the next 7-8 months. Essentially is not even the cost that he expenses for his commute, right? So look at the borrower's indebtedness. If a borrower is making 100 rupees a month and was spending 90 rupees, will surely reject such a borrower. So you have to always,
Sorry,
the guy is not leveraged, he'll always repay.